Hi, welcome to Chapter 8. We're going to discuss the home and automobile decision. So, in this chapter, we're going to talk about making good buying decisions, choosing a vehicle that suits your needs, choosing a house to meet your needs, deciding whether to buy or rent, calculating the cost of buying a home, getting the most out of your mortgage. So, let's start with buying a home. This is the single biggest investment most people will make. There's if you're a college graduate, which I assume most of you will be soon, buying a house is probably the biggest investment you'll make, and there's a high percentage of college graduates who eventually do buy a home. Buying a car is another major purchase. You may already have purchased a car, and this could be new or used. So when buying a vehicle, of course, you want to find one that fits your lifestyle, your image, and your wallet. Um, Now, you're going to need to make a loan, and this is going to dramatically impact your finances. Now, what's nice about getting a mortgage or buying a home is that you get to stop throwing your money away on rent and start throwing your money, your housing money to yourself. So that way you're kind of contributing to paying off an asset, which at the end of the life of your mortgage, you get to keep. And anytime during the mortgage, you can also sell at a profit, pay off your loan, and walk away with a profit, something you can never do while you rent. So buying things is smart. You're collecting some tangible assets. So, but here are 4 steps in smart buying. One, differentiate want from need. Do your homework. Make your purchase. Maintain your purchase. So here's a quick checklist before you buy. Um, know exactly what you want and what you can afford. They could be two different things. You have to do your research. I mean, you want to check, you know, the internet for ratings, reviews, ask family, friends, trust advice on their experiences, gather information about the seller, the item, the service that you're purchasing. So the more research you could do, the better. Even for something as simple as buying a TV. So some of these high definition TVs, there's a lot of technology out there, a lot of different sizes. So you really want to, do your research before you buy something to make sure it's going to be the best solution for you. Never buy an impulse or feel pressure to buy, um, especially at an auto dealership. You want to make sure that you always take a day to think about it before you sign on the dotted line. You should know before you purchase, you should know what is the refund policy, the return policy, cancellation policy. Um, Make sure you read the contract before you sign it, and don't sign it if there's a part of it you don't understand, or if there are any blank pages in it. Now, salespeople can use very high pressure sales tactics. So the best thing to do is to walk out if you feel pressured or overwhelmed. Never force yourself to feel like you have to buy something. So real estate agents, they don't work for you; they work for the seller. If you go to an auto dealership, their best interest is to sell to you because they're going to get a commission. Even if the product is not right for you, this still won't be taken to their account because they want to make the sale. They want to get that commission. So you're really on your own. Um, get everything in writing. Verbal promises mean nothing. Okay. Now, here is another checklist on the making a complaint. So, write a letter or an email. Usually, the best approach. You have a record of what you're trying to say in communication with the company. Be very clear and brief to the point of what the problem is, and include as much information about the product as possible, where you purchased it, serial number, model. Um, Say exactly what you want them to do about it. You know, replace, repair, compensate. Never be angry, sarcastic, or threatening. Always come from a neutral place. Provide your name, contact information, and keep as many records as possible if there's a problem with your purchase. Um, Here's an example complaint letter that And we're talking, this is something you do for large purchases, of course. But even, say for example, you buy even, some electronics, a computer, a TV set, and there's problems or issues with it. These are some things that you could state in your complaint letter. Now, remember that when when you are a couple, and especially if you joint finances, spending can be a real problem. So oftentimes people feel that their partner is spending too much. It's unfair. So control your frivolous purchases. Keep on top of your budget. A lot of times, if you buy something frivolous, that's really not a wise thing to purchase, or impulse buy, this could cause arguments. Um, and couples especially, argue more about money than anything else. So make sure you have clear lines of communication with this. Let's talk specifically about buying a vehicle. So some things to consider. Do you want to buy new or do you want to buy used? So new is definitely going to be the most expensive option, and it's going to be where you lose the most money the quickest, because as soon as you buy something new and you roll it out of the showroom, it immediately loses a lot of value. So buying used can often be a much better deal, even if it's 1 or 2 years old, still a great car, still relatively new, but it can be tremendously lower costs. And there's also leasing. There are a lot of, yes, you'll pay more with leasing, with leasing, that's common knowledge, but there are some advantages to leases. The monthly payments typically are much lower with leasing, and you can basically get a new car every 3 years. The disadvantage is that you just have always a monthly payment. Okay, so let's talk about step one. Differentiate want from need. So as far as a vehicle, first, it's really to best thing to quantify, um, what is it that you really want, and why do you want it? And then think about what you need. What is the bare minimum that you need? And this is, um, something that takes some time to think about. As far as, oftentimes cars are sold on emotion and cars are sold on styling, but you know, sometimes getting the more expensive car is not something you really need. So really just deciding, what features are a must to have in your car. Um, I would usually suggest always going with the base model and never paying for extras from the dealer, because dealer usually charges 2 or 3 times what you could do to get that extra. For example, if it's a car alarm, you might pay $800,000 at the dealership, $200 somewhere else. If it's an automatic remote start, it could be $800 at the dealership, $200 at a independent store. If you're looking like an onboard navigation system, might be an extra $1,000 to have that installed at the dealership, or you could just use your phone. And most cars come with Apple Play or Google Play, and you could just use your phone to navigate and save all that extra cost. Now, you want to definitely do your homework. How much can you afford as far as a down payment and a monthly payment? So what do you first figure out what you're comfortable with? You might be comfortable with putting $2,000 down and having a $300 monthly payment. So then you have to find a vehicle that will fit within that category. In that category, that would mostly be a used vehicle. So once you determine, how much you can afford, this will give you an idea of the cars that you can afford. And then you can start doing some comparison shopping, where you go around and see what prices are available. And you have to also figure in that buying a newer car, usually insurance costs will go up. And maybe, you may have to purchase a warranty. So there are other costs involved with um, choosing a new vehicle or a used vehicle that you should think about. Um, Now, you could also go to websites for used cars, like Kelley Blue Book is a site where we'll give you the value of used cars, so you can independently check against what they're trying to sell the car for versus what the value of a used car for. Remember, the value of a used car comes into two categories. The value would be if you buy it from a dealer, and the value if you buy it for some individual person or as a private sale. Usually dealers charge more when you buy a used car from them than if you buy directly from another person. Um, so before you make the purchase, you want to make sure, are you getting a fair price? And that's why I was saying you always want to check what is the actual value of the car. There's many different websites where you could check that. You want to know, what is the dealer cost, or what did they pay for the car? Um, Dealers usually may hold back incentives from the manufacturer, so you should usually check, if you're buying a new car, check the manufacturer's website, see if they're offering any current incentives, and then you can ask the dealer. I see on the website you have 0% there. Honda's offering 0% financing. So um, and you make sure you get a quote, and you can, if you're using a dealership like Honda, you can go to two different dealers. The independent dealers often will compete against each other, and you, to a certain extent, you can negotiate. But there is a bottom line price where they can't go any lower, and they generally do give you a hard time when you try to negotiate. But there are certain things, um, it can pay off in certain times. Here's some tips on buying a new vehicle. Um, Make sure you look at the Consumer Reports. It's a great way to review cars and information about cars. Know what the know what the dealers paid for the car. So in order, you know, to get a better idea, like I was saying here, the Kelly Blue Book, here's the website, get you a better idea of what the costs are involved. So make sure that you check if the manufacturers offer any rebate or special financing deals. Uh, Always get several quotes. And if you're going to finance the car, make sure you check your local credit union in addition to the lending rates that the auto dealership will offer you. Um, Now, I suggest never get any extras at the dealer. You're going to be paying a lot more at the dealer. And a lot of these extras, like rust proofing, window etching, they're just mostly bullshit. And they're just going to cost you a lot of money and give you very little for the car, especially if you tend to only want to hold the car for a few years. For example, I'm always approached to get an extended warranty. So the car is naturally going to come with a 3 to 5 year warranty by itself for free. The extended warranty may extend out to 7 or 10 years. Typically, this is a lot of extra money, and in most cases, you won't keep the car that long where you will be even able to use the extended warranty. Um, Make sure you inspect and test drive the vehicle to make sure you fit in it. It feels good. You like the ride before you buy. Um, and take your time. You don't have to buy the same day you walk into the dealership. The car will still be there the next day, even if they say it won't be, or this is the only time the deal is on. And they'll put all this pressure for you to buy sooner than later. Um, so sometimes leaving without buying is fine. If the salesperson is good, they'll follow up with you, or they might make a better offer the next day. Um, they say the end of the month is the best time to buy a car when dealers are trying to make quotas. It's not always the truth. Sometimes the end of the month, everybody knows that adage that the best time to buy a car is the end of the month, end of the quarter, but it's also the busiest time. And if they have low inventories, they really might not make you a deal. So sometimes the beginning part of the month when the dealership's not busy at all, you can get good deals too. So I don't always subscribe to the end of the month notion. Um, Negotiate. Should always try and negotiate because there might be some wiggle room there. Um, and always, you know, inspect the car, look at the car in daylight hours, so you can check. Make sure you check all the features: the lights, the air conditioning, the heater, electrical system. So you want to, if you're buying a used car, you may want to have it inspected by an independent mechanic, or your mechanic are used to have them look over the car. Um, Ask questions. Was the car ever in an accident? Did you have any mechanical problems? Can you show me a history of maintenance on the car? Um, and don't sign any contracts or any loans that you don't understand. Read all the documents before you sign them, especially at a dealership. And then finally, make your purchase. So you found a car you like, it fits in your budget, and you want to make the purchase. So for certain used cars, you might only have the option of paying cash for them, depending on, certainly cars less than $10,000. But you want to investigate what are your financing options. Um, But keep financing out of negotiations. Don't let them try to use financing as part of the negotiation. So you can finance independently at your own credit union or bank. You don't have. They usually try to make additional money from financing directly with you and the car lender. Um, and if you can afford the shorter term, the 3-year auto loan, try and get that if you can afford the monthly payments, because then you have a quicker time paying it off. You'll be paying less interests. Now, leasing isn't always a bad idea. You know, now if what's nice about leasing, you get a new car every 3 years, and if you drive less than 15,000 miles a year, it might, with great credit and no money down, it might actually be a good choice. So a lot of leases come with a purchasing option where you can purchase the lease, an extension option where you can extend the lease. Um, so leasing, always double check the leasing, because it's not, especially if you're someone that tends to only want a new car every 3 years. Sometimes um, leasing is a great option. You always have a monthly payment, but just a low continuous monthly payment. And since cars depreciate so quickly, you really don't get that much of an asset after you pay off the loan. There really isn't that much left. So if you are leasing, make sure you consider a closed-end, not an open-end lease. They're usually a little bit better deal and more. You have a more permanent knowledge of what is going to occur and when the lease is going to end. You're financially stable. You have recurring incoming money. Um, if you like the fact that you have a new car every 2 to 4 years, that you have no repairs, less worry about mechanical failure, that you don't drive a lot. Don't lease if you drive over 15,000 miles a year. It just isn't worth it. You take good care of the car, and you're aging. You're not really hard on the car. Or that your driving usually tends to make the car in pretty good shape after a couple of years. Um, you're not bothered by the thought of always having a monthly payment for your car. Um, you typically don't modify your car. You keep it factory stated. So any modifications you make in the car, I mean, you basically are not going to get the money back for that, and may actually void some of the warranty. Um, and you can get a really low pricing option on the lease. A lot of times dealers, since they make a little bit more money in leasing, they have more wiggle room to offer you a better deal. So once you have, a good lease, you want to make sure that, you've negotiated before you sign the lease. Of course, there's a minimum. You try to minimize the amount of money you put down. Um, the warranty is going to define as normal wear and tear. So you basically don't want to have to be charged for new tires when you bring the car back in. That there's no, that there's no termination fee or depreciation factor. So there's a lot of things that you want to, make sure that you're getting a good lease. And most car companies, direct car manufacturers, Honda, Ford, Acura, Toyota, they have a pretty standard lease contract. Here's one as an example where it's just going to be very standard. It's not really tricky. It's pretty straightforward because they're not in the business to try to really stick you with a lease or create you make you unsatisfied as a customer. So typically most leases are pretty straightforward. Now, once you do buy the vehicle, it's important to maintain your purchase. You want to keep the vehicle in good running condition. It means that you want to follow all of the guidelines of, uh, you know, diagnostic repairs, oil changes, routine maintenance. Don't ignore any signs of trouble. That check engine light comes on, bring it right to the dealer. A lot of times, almost all the times, you have a lease or new purchase of a new vehicle, you're going to have a warranty, and the warranty is going to protect you against big mechanical failures that aren't your fault. It's just a design flaw in the vehicle that could cost you thousands of dollars to repair in a used car, usually covered for free at the warranty. So if you have a lease, or a new car with a warranty, it's usually pretty good to bring it to the dealer because they can automatically cover anything that's covered under the warranty. And know your rights. There are things called lemon laws that protect you from cars that are just totally, worthless, uh, mechanically impaired type of vehicle once you purchase it. If it's just really a lemon, meaning that it wasn't represented is represented as a well-functioning car and it wasn't, there are laws to help protect you against that. Now, this is here is a strategy for a worksheet for lease versus purchase decision. So basically, you could put down your numbers on the cost of purchasing versus the cost of leasing, and you'll find out that most of the time the cost of leasing is a little bit higher than the cost of purchasing. But it really depends personally on what you're trying to do. If you want to buy a car and drive it for 10 years, definitely purchase. If you want to own a new car every 3 years, then the extra cost of leasing may be worth um, it to you. You know, so this is really, I think leasing is more of a personal preference. I really don't think, in most cases, leasing is more expensive. However, you get more benefits with leasing, so it's sort of a trade-off. Let's switch over to buying a house. This is a much bigger purchase and something that will last a lot longer than a car. Um, Now, home ownership is one of the biggest financial goals you should have, and it's because the homes are a store of value, unlike renting where the money just is gone. When at least when you're paying a mortgage, part of it goes to paying a principal on an asset, which 99% of the time over a 10-year period will appreciate in value. Now, in the housing costs, um, it shouldn't be more than 25% of your after-tax income. So that's an important figure when you're ready to buy a house. If you have enough monthly income where 25% of it could be used to pay for the mortgage, then you're ready to buy a house. Now, it's it's an it's considered an investment, but if you ever did look at, if you own a house, the cost of the mortgage, the cost of maintenance, the cost of real estate taxes, when you buy a house for 300,000, 15 years later you sell it for 600,000 and you think you made a $300,000 profit, it's really much less after you factor in all the additional costs of owning the house, but still you come out way ahead of renting. So you want to be smart when you're buying your house. You don't want to overpay. You don't want to put yourself into financial trouble. Um, so basically, when you're looking at a house, it's houses do offer more space and more privacy, and that's why as you get older and you start a family, or you really do appreciate having some space and privacy from your neighbors and some peace and quiet. Um, a house definitely you have a really really good chance of capital appreciation, being worth more when you sell it compared to when you bought it. But on the downside, you're responsible for maintenance, repair, renovations, taking care of the lawn, the outside, the inside. You're responsible for all of it. And, home repairs can be quite expensive and unexpected when they occur. There are also cooperatives and condominiums, which a cooperative is not like owning your own home. It's like owning shares in a corporation that gives you the rights to live in a particular unit. And cooperatives have much higher maintenance fees because their maintenance fees usually include taxes and energy. Now, condominiums is closer to owning a house, and the homeowner fees are much less in the condo, but you're responsible for paying your own taxes. You're responsible for your own utilities. Um, and cooperatives and condos are usually attached premises, much like an apartment, and you have to deal with neighbors, but they can come at a much lower cost than buying a house. So it's sort of an interim step. If you go from renting to owning a co-op or condo and then sell that and move into a house, it could be an intermediate step. But be careful of cooperatives. Um, their monthly maintenance fee tends to be a lot. So if you make sure you add your mortgage to your monthly maintenance fee and see, is this really saving you a lot of money? In some cases, it's not worth, they don't appreciate it as quickly as a home as either. Now, of course, renting and if you're renting an apartment, it's a lot lower in maintenance costs and repair costs, but again, you're just throwing your money away. You're not getting any of that back when you pay your rent. Now, again, when you're buying a house, think about, you know, what type of house is important to you. Uh, And you want to know before you look, like, what design do you want? A ranch? Do you want a split? Do you want a high, do you want a two-story? And so you want to know all this. You want to know about affordability, location, neighborhood, conveniences, schools. So you really want to have an idea of what type of living situation would be best for you, how close you are to the stores, what type, the level the schools are at if you have children, the neighborhood, you can look at crime reports, history reports, demographics. There's a lot of research you can do before you buy a house. And you may look at up to 30 homes before you decide on which one to buy when you're doing your homework. So when you're buying a house, you're buying, there's a lot to think about and a lot to look at. Now, the biggest thing to do your homework on is how much can you afford to pay. So roughly you take your after-tax, your monthly after-tax income and figure out what 20 to 35% of that income is. And that's probably a good ballpark of what you can afford. Now, the payment of your home in the first 5 years seems like a lot, but then the last 5 years is going to seem like very little because the payment of your home definitely does not increase as quick as rent does. And your salary will probably increase much faster than the costs of your monthly cost of your home. So after 10, 20 years of living in your home, it's become much, much more affordable. Now, some of the one-time costs of buying a house, and this is one of the big disadvantages of buying a house, is you're going to put a lot of money up front. So there are down payments, and typically you want to put 20% down to avoid the PMI tax. This is a tax if you have, I shouldn't say tax, it's a cost of purchases or insurance if you don't have at least 20% down. So it does, that 20% down will not only lower your mortgage by the fact you're putting 20% down, but it also will lower the cost of your mortgage so you don't have to pay that PMI costs. Um, there's also closing costs. There's points or discount points you pay for. These are ways of lowering the interest charges. I usually don't recommend buying points. Loan or origination fee, loan application fee, appraisal fee, title search fee. I mean, basically, when you go to the closing, you're going to bring your checkbook and write all sorts of checks because there are a lot of additional costs and taxes when you buy a house and settle a house. So if you look at, here's an estimate in this particular chart here. If you look at this, that you look at your down payment, your points that you have to pay for, but this is optional. You don't always have to buy points. I usually don't recommend it. Loan fees, appraisal fee, title search, title insurance, attorney fee. That's very cheap. Most attorneys may charge $1,000. Recording fee, a credit report fee, termite and radiation inspection fee, notary fee. So you're looking at a significant amount of, and this is what keeps most people out of a home, is that they have to pay so much up front to get into a home. So if you don't have a significant amount of savings, and this is just, looking at purchasing a $150,000 house with $120,000 down, 20% down, at a rate of 4.5% with 2 points. Here, I would say double everything. You're not going to really get into a house for less than $300,000. So it might be $70,000 you need to get into a house with 20% down. Now, some of the reoccurring costs when you own a house is going to be the monthly mortgage payments. So these monthly mortgage payments, the nice thing about them is that they remain stable. So from year 1 to year 29, you're going to be paying the same amount for this monthly mortgage. And towards the end of the mortgage, it's going to seem a lot cheaper than the beginning of the mortgage because of inflation and the change of your salary and things of that nature. So now the PITI, we're talking about, which stands for principal, interest, taxes, and insurance. These are things that you pay above, your mortgage payments. So in addition to paying off the loan principal, you have to pay the interest charges, the property taxes, and insurance premiums. So these also get rolled up. Now, if you have a mortgage through a bank, they'll roll all these into your mortgage. You know exactly what the cost is at the bank. And then once you own a house, you're also going to have to pay for repairs, renovations, upgrades, landscaping. So there's a lot of additional costs that come with living in the house. And the longer you live in the house, the more these costs are going to be required. Okay, so here's a monthly mortgage payment required to repay $10,000 loan at different interest levels. Okay, so what we're looking at here, this is, a 10-year, 15, 20, 25, 30, 40-year mortgages, even 40-year mortgages. And the difference levels of what you'd pay depending on the interest rate. Of course, the higher the interest rate, the more you'll have to pay for your loan. This is just a continuation. Now, it'd be a rarity to have a rate at interest rate this high, but it's possible. Okay. Now, renting versus buying. Sometimes you don't have a choice. You just don't have the money to buy, so you're stuck renting. In that case, if you're looking to buy a house while you're renting, you may want to try to lower your rent obligations as much as possible, and that might mean considering a roommate or considering, you know, maybe living at home and having a reduced rent from your parents. But the advantages of renting, some people rent even though they can afford to buy a house because it's easier to move, especially for changing jobs. Um, it's more flexibility. It's more, you can change your residence more often. But there are costs for each alternatives, of course. So the real advantage of buying is the long, the longer you stay in the home, the more value you'll appreciate. You can, certain items on housing is deductible, and it's a way of almost like forced savings because part of what you pay in your mortgage goes into paying down your home, which you get back when you sell your home. Now, here's a chart. If you look at rent versus buying on the two sides here, um, renting does, especially when you're young, the mobility is the best thing of renting. Just being able to change your residence relatively quickly. There's no, it's a huge hassle to sell a house. Much easier to move when you're renting. Um, it says no down payment required, but if you've ever rented a house, you know you're going to need a 2 or 3 times the rent to move into the house. Sometimes you need first and last month's rent, or first and last month's rent plus a month's security, or in some cases first and last month's rent plus a month that you have to pay the real estate agent. So, but the renting does involve a lower monthly charge. So when you rent a house, you definitely should be paying less than if you buy a house. Now, you don't have the risks if the housing market crashes, which doesn't happen often, but is possible. Um, and you might have more amenities. Some apartment complexes have swimming pools and tennis courts, gyms. You don't have to worry about maintenance or landscaping or property taxes. But buying a house allows you to build up equity. It allows you to have sort of like an investment. Uh, Most houses will appreciate. You have a lot more freedom. You can do whatever you want in the house, barring what the town excludes. But, remodeling, changing landscape, changing your resurfacing your driveway, you can do really whatever you want when you own a house, but you can't do that while you're renting. Or if you have a condo or co-op, a lot more restrictions. Um, and depending on your income and whether you itemize deductions and what state you live in, there's a lot of tax advantages to owning a home. And there is no increase in the mortgage over time. So once you lock your mortgage in, that's going to be your rate from today to 30 years when you pay it off. And in 30 years, that mortgage rate will seem like a very small amount compared to what people are currently paying for rent. Um, and it's a potential source of addition of collateralized loan income if you're going to take out a home equity loan while owning. Now here's a more elaborate worksheet on um, the cost of renting and the cost of buying in a 1-year perspective versus a 7-year perspective. So you can see that the cost of renting here in 7 years is 77,000, versus if you look at the cost of buying over 7 years, it's much less. So, but this is depending on, if you want a more detailed decision, renting versus buying, this is something that you can easily put together. Now, determining what you can afford. So, what's the maximum amount the bank will lend you? This is going to depend on your financial history, your ability to pay, your appraisal value of your home. Okay. Um, all right. Just looking ahead for a second there. But so Should I borrow up to the maximum of what you can borrow? Depends. And how much of a down payment can you afford? So these are questions that you need to ask before you can really buy your house. And you want to always put yourself in a position where you can afford the house, because you don't want to, be in a position where you're going to default on the mortgage. Now, if you look, this is a worksheet that's also in the textbook. This is to calculate your maximum mortgage loan for which you'll qualify for. So when you're calculating your mortgage limit, they have to look at your ability to pay. And not just to pay what's owed in the house, but also to pay, the insurance and taxes as a percentage of your gross monthly income. And they're going to also want to look at your other monthly obligations like auto loans and student loans. How does that factor in compared to your income? You also want to look at the appraisal of the house. How much is the house worth? Are you getting a good deal on the house? Is the house worth more than you're paying for it? So these are all factors into how much they can lend you and what you can afford. Now, when you do have an idea of what you can spend or how much you want your mortgage to be or what size house you can buy, then you can start looking for mortgages. So savings and loans, commercial banks can offer a mortgage. Credit unions are probably the place where you can get the best deal on a mortgage, because credit unions typically have a lower rate of interest and better terms on the mortgage and the mortgage contract as far as additional fees and costs. There are also mortgage bankers that can originate the mortgage loan, and there's a mortgage brokers, it's a middleman that can help you shop, compare loans, sort of like a real estate agent for mortgages. Now, think about the mortgages. No matter where you originated, more times than not, the mortgages will be resold to somebody else and repackaged and resold, where your bank or credit union may be the management of facilitating the loan and the payments, but the actual loan will probably be resold to another investing institution. And it's not that you may not even know this is happening behind the scenes, but this is how banks and credit unions refund their lending and how those mortgage-backed securities are created. Now, conventional loans from a bank or credit union are going to be secured against the property. Uh, government bank Government-backed loans are lenders that are insured by the government. FHA or VA loans, these are special loans that you qualify based on your military service or your income level, and these can offer lower rates of interest, smaller down payments, less strict financial requirements to qualify for a mortgage, but typically have more paperwork, higher costs for closing, limited funding. But it's definitely worth looking into these programs to see if you qualify for them. There's also could be a lot of programs for first-time home buyers. For example, some tax deferred accounts like a 401k, depending on your situation, how much money you make, and if it's your first time purchase, you may be able to withdraw money from one of these tax deferred savings accounts without penalty or without having to pay taxes on to pay for your first house or your down payment on your first house. So you want to look into what's currently available. These things do change. Now, I do suggest a fixed rate mortgage where monthly payments will not change with a fixed rate mortgage. And you can lock in a low interest rate for the life of the loan. So if interest rates are historically low already, you may want to lock in a fixed rate. Or if interest rates are increasing, you might want to lock in a fixed rate. Now, you can always refinance later if mortgage rates become lower. Um, and you also want to make sure that what are the prepayment privileges? Do they allow you to make additional payments to principal without having a penalty? So these are things you want to ask about a mortgage. But definitely, fixed rate mortgages are less risky. The adjustable rate mortgages will give you a lower overall interest rate compared with the fixed rate at the time. Some of them may have an initial teaser rate that's even much lower. However, if they're adjustable and interest rates go up, then your mortgages will go up. At a certain point, your teaser rate will expire. If interest rates go up, you might, in some worst case scenarios, be paying 50 to 100% more than you expected with these adjustable rate mortgages. So I don't really suggest these, especially in an interest rate environment that's constantly changing. Now, margin is the amount over the index rate that the ARM is set for. And so there are different rules when it comes to a adjustable rate mortgage that you should be kind of aware of. So there's the initial rate, and this could be a short rate for the first 3 years. And some people don't understand that this is just an initial rate and it changes. Um, but the margin, this is set at the 6-month Treasury bill rate plus 2% margin, and the margin is the amount added to that index to obtain the rate. So this is what's going to change. So you have to look at what the adjustment interval is. So adjustment interval is defined how frequently the rate on the adjustable rate mortgage can reset. Is it once a year? Is it every 6 months or every 3 months? So this could be negotiated, or this could be very different depending on the longer the adjustment period, typically the better. Um, so most of these mortgages have a 1-year adjustment rate where they adjust every year. Some of these can have what we call a rate cap, and the rate cap limits how much the interest rate in the ARM can be changed. So it might be limited to only 2% a year. So if the index goes up by 3% and your cap is 2%, it's only going to go up by 2%. So this is a nice feature to have. So the payment cap is a dollar amount of how much the monthly payment can increase during any particular period. So this is another nice feature where there could be a certain maximum set on the payment increase. So there are some other types of adjustable rate mortgages, some that can be converted to a fixed rate loan. So this conversion can be very useful if fixed rates are much lower in the future. So if it's a high rate of interest now, you might want to get this convertible. Reduction option ARM is a one-time opportunity to adjust the interest rate. So you get a one-time opportunity to adjust the rate of the loan. Um, Generally, if it occurs in 2 to 6 years, you might be able to choose that, or a two-step ARM, which combines both aspects of a fixed rate and an ARM. And these are a little bit more complicated. And all three of these innovations are not highly utilized. They're probably less than 5% of all the loans that are out there. Now, so what's the advantage of these adjustable rate mortgages? One, you get a lower interest rate in the beginning of the mortgage. Um, but it can become can be a larger loan because oftentimes the PITI is lower, and you can reset the interest rates or push the ARM payments up, which would push the ARM payments upward, um, or sometimes downward too. So that is sort of the unknown quantity of these. You don't know what the rates are going to be. But if fixed rates on the other side are, I think they're better than a adjustable rate because you know exactly what you're going to have to pay forever. There's no really changes going to happen. So it allows you to control and budget much better. Now, some specialty mortgage options, there are balloon payment mortgage loans, which you pay a small monthly payment for 5 to 7 years, then the entire loan is due. Don't recommend this. The graduated payment mortgage, which payments are set in advance and rise for the first 5 to 10 years, then level off. So this can help if you're starting out and you have a low income and you're probably going to be growing your income as you get older and more established in your career. This could be something that can get you into a house sooner by making the payments a little bit easier in the first 10 years. Growing equity mortgage is another type of mortgage. It's designed to let the home buyer pay off the mortgage early, which is done by paying a little extra every year. So it doesn't really help if you're tight on cash, but the payments on a growing equity mortgage begin at the same level as a conventional mortgage, but each year the payment is increased, and this increase goes to pay off the principal, which means you typically can pay down your mortgage quicker, and then it might result in a 30-year mortgage being paid off in 20 years. Some people will make 1 or 2 extra payments on their mortgage a year, and this helps to um, greatly reduce the time frame of the mortgage. You're just paying it back early, basically, but on the schedule. Shared appreciation mortgage, the borrower receives a below the market interest rate. In return, the lender receives a portion of the future appreciation, anywhere between 30 to 50% of the value of the home. So basically, you're trading off some of your gains on the home for a lower interest rate. I don't really recommend this because usually you're going to make out better paying the higher interest rate. Um, than giving 50% of your equity. The only of your gains, appreciation. The only time where this may pay off is if there's a housing stagnation, there's really no equity added to your home over a certain period of time, then the lower interest would pay off. And then there's an interest-only mortgage, which it's not that you only pay interest, is that um, it's the beginning of the loan, you're paying only interest. So it can make the payments a little bit lower, but eventually you're going to have to be paying back those principal payments. So as a result, you only make interest payments for the initial set, maybe first 3 to 5 years, and then later you're going to be paying back both interest and principals. So basic principal amount. So basically, it makes the beginning of the loan much cheaper, but then the end of the loan much more expensive. So again, not recommended. Um, there's an option payment arm mortgages, and you can make different types of can make different types of mortgage payments each month. So you have the option of making um, you know different amounts. So you can pay an amount less than the interest due on the loan, interest only on the loan, or payments that would be equal to uh, a 15 or 30-year loan rate. So it's just an option. I don't highly recommend this either. So with the specialty mortgages, you got to be careful because sometimes this is what created the real estate crisis and the real estate bust in 2007 and 2008 was they were giving these specialty mortgages out and not explaining to people that there's going to be a big jump in their monthly payments. And to some people, they're saying, listen, you get the house, keep it for 3 years, you'll pay this low mortgage rate. Then the third year you sell it for a profit and then you can get a different mortgage. So, but when the prices of the home started going down, people weren't able to do that. So you got to read the fine print of these specialty mortgages because in most times they benefit the lender more than they benefit you. So you always want to know how much your monthly payment can increase to. What's the maximum that you'd have to pay if the worst case scenario happened, interest rates went up and a teaser falls off. So that way you have a better idea of what's the worst case scenario and what the penalties are if you pay these mortgages off early or refinance. You always want to know that. Now, you want to stay away from um, mortgages that are subprime mortgages or predatory lending. So if you're in a situation where you really can't afford a house, sometimes these subprime mortgages make it possible for you to afford a house. Um, Especially if you have a low credit score, but you're overpaying if you get a subprime mortgage. Better to work on your credit score and improve your down payment and financial position and come in and get a mortgage at the best rate possible as having the highest being in the higher tier credit rating rather than accept a subprime mortgage. It's basically, you know, giving mortgages to people who aren't financially yet qualified for a mortgage or have the financial credibility yet for a mortgage. So predatory lenders will take advantage of these people and you pay significantly more with these subprime mortgages. And there's a lot of loan abuse and how these are created and the cost of these loans and the payoff schedules. And so you're best to understand that if you're not ready to buy a house, you don't have the financial strength yet or the credit history, don't buy the house. Stay away from these subprime mortgages. Don't pay more than what you should for a house, basically, because it's going to make it much harder to pay it off over time. Here are some common predatory mortgage lending practices. Um, One, if the interest rates are much higher than the going rate. If there's excessive points or brokerage fees that you have to pay to get into the mortgage. If they don't consider you're really considering your ability to pay, they don't really care about you. They just want to get you into that mortgage, get their fee, and they want to move on. Um, if there's a lot of kickback to the brokers, if there are balloon payments, if there's loan flipping, um, which is, you have to refinance it in order to like stay in the house. If there's prepayment penalties, never accept a mortgage with a prepayment penalty. So you got to be very careful. If something feels, this is why you might want to have a mortgage broker help you that's going to be on your side, that maybe you don't pay them commissions, but you pay the broker a flat rate, something where they'll be more amenable to make sure you get the best deal. So should you select a 15 or 30-year mortgage? That's a good question. 15-year or 30-year? Well, the with a 30-year mortgage, I always say go with a 30-year mortgage because you should be able to make prepayments to this mortgage and treat it like a 15-year mortgage, but you have the option of paying a lower monthly rate. So get a 30-year mortgage, pay extra into it when you can, but when you can't, you can still be paying that lower 30-year mortgage rate and get not stuck into a high monthly payment of a fixed year mortgage rate. So now the one benefit of a 15-year mortgage is you're typically going to get lower interest rates on a 15-year mortgage than a 30-year mortgage. That's the only benefit, but it's a higher and stronger financial commitment to get the 15-year mortgage because the monthly mortgages will be higher for each month. So you see here, if you look at the 15-year, here's the 15-year um, mortgage, and if you look at the portion of principal to interest paid, um, so over time, the beginning of a mortgage, you pay mostly interest and very little principal. And this shifts as the mortgage gets older. So on a 30-year mortgage, you're paying mostly principal at the end, but mostly interest at the beginning. So that's why trying to pay down that principal a little bit sooner in the beginning by making extra payments on your mortgage will greatly reduce the interest overall in the lifetime of the loan. So this is what you have to understand, that the bank gets their interest up front because you have bigger um, principal amount in the beginning, which leads to more interest before you start paying that down. So if you look at the payments compared to the total interest, on a 30-year mortgage, the monthly payments might be about $500, but you're going to pay $93,000 overall in the lifetime of that loan and interest. In a 10-year mortgage, the monthly payments are double, but you're only paying $27,000 of interest. So in some cases, if it's this low, it'd be better to have a 10-year mortgage where you pay $1,000 a month compared to a 30-year mortgage and pay $500 a month. But this is only a $100,000 property. So you can multiply this by 3 if it's a $300,000 property, and you can increase all these values by 3 to get just a quick reference. So again, the advantages of a 15-year mortgage is lower interest rate, quicker payoff time, equity is built up faster, you're going to pay overall less interest. The advantages of a 30-year mortgage is best advantage is you have lower payments, better flexibility. It's more affordable. Most mortgages, you can prepay the mortgage off early without penalty. And you can control how many years it takes to pay off the mortgage. So if you're having a hard financial time for a couple of years, you can just pay the minimum. And when years are better or you get bonuses, you can start making advance payments to the principal. Okay, so coming up with a down payment. I always suggest have at least 20% down on the house because it makes the house the most affordable. So how do you come up with this down payment? It takes some time. Maybe friends and family will give you some money towards your down payment. Remember that 5% of the closing costs come from the home buyer. So you also have to pay for that when you get into the house. So trying to spend few years scrimping and saving and living below your means to accumulate that down payment will get you into a house sooner. There is, you have to remember about private mortgage insurance, which allows you to borrow more than 80% of the appraisal value, but you're going to have to pay. So if you pay more than the appraisal value of a home, the home appraises for $300,000, but you're going to be paying $360,000. You're going to have to get additional insurance for that. That's the PMI insurance I was talking about. So that's why if you put 20% down, you usually avoid this PMI insurance. Pre-qualifying yourself by going to your bank and trying to pre-qualify for a mortgage will give you a better idea of how much you can borrow and make you a better negotiator when you're trying to buy a house. Saying that you're pre-qualified means that you'll get your mortgage. You should get your mortgage sooner and more certain of getting a mortgage. And of course, before you purchase, make sure you comparison shop. You use a traditional real estate agent to can help you with this. You can also get a real estate agent that doesn't represent the seller, but you can get a real estate agent that represents you, the buyer. And this means they will still earn some commission, but they're working for you, not for the seller. So they're more on your side. This is a buyer broker. And that sometimes having a buyer broker is better because they can get a better deal for you, a better negotiation. The typical real estate agent will try to side with the seller and get you to pay as much as they can, and usually don't like it when you try to negotiate or try to limit the negotiations before it even gets to the seller. But the buy broker is better because they will represent you with a stronger negotiation front. Get the house inspected to make sure there's no obvious huge flaws that you're going to have to pay for, um, and make an offer. If it's a buyer's market, you can haggle more for sure. If it's seller's market, then you might have competitive offers that would outbid you and you lose the house. So you have to really decide what type of market it is before you haggle. Um, Now, there are some other additional things about buying a house, such as there's a contract. So a contract has to be created, and this is what a a real estate attorney will help you with. So a real estate agent and a real estate attorney, they'll help nail down this contract. And let's see, just seeing what's up ahead. So in the contract, the price, the method of payment, agreement between the buyer and seller, the date, where you take possession of the house, the information about the title. The house has to be certified against termites and radon. Um, some, so the contract is just going to spell out in legal terms what exactly the deal is. So that's why you need a good lawyer to negotiate a favorable contract for you. Um, Now, there is the earnest money. So if the contract is accepted, the buyer will give the seller what is this earnest money, which is the deposit basically to ensure the purchase. So having the deposit really makes the seller feel a little bit more comfortable, because if you don't buy the house, then that money can typically go to the seller, but not in all cases. So at closing, this is when the title is transferred from the seller to you or your bank. So the bank really owns the house and so you pay off the mortgage, but basically the title is in your name and in conjunction with the bank. So and so also at the closing, there's going to be a lot of other things that must be paid depending on the state that you live in. And the settlement or closing date is the date at which this is going to go down, where all this you're going to meet with your lawyer, their lawyer, the banks, and all this on the attorneys, and you come in a room and then you write a bunch of checks. If everything goes well, you're handed the keys at the end of that. So, checklist for buyers and sellers. So, if you're selling a house, make sure that you decide to work with real estate, or I'm sorry, a real estate retailer, um, a real estate agent. You are going to look for one that's, look for an agent that's working full time, that has at least 3 years experience, that, has a lot of experience making these transactions, that make sure that there's an out clause in the contract to let you terminate the contract whenever you want. So you don't lock in a bad agent for 6 months that doesn't sell your house, it doesn't work on selling your house for anything. So pick a retailer a real estate agent who lives in the area that you can work closely with. If you're buying a house, remember, you have to decide on what you can afford and what your maximum minimums are. Avoid um, the need for putting PMI down, private mortgage insurance. So if you put 20% down in the home, this will you eliminate this cost, which can be significant. Um, and when you're looking to borrow, you have a good idea of what lenders you're going to go to and get pre-approved, and understand how the real estate agents compensate. Generally, there's going to be a commission, and depending on the deal, is how this commission is structured. But usually, the seller pays the commission. Okay, but that commission is going to come out of the price you pay for the home. So in a sense, you're paying for it really. And then make sure you maintain the purchase, especially with a home. You want to keep up with your maintenance, keep up with your repairs, keep up with your landscaping. So it's always in a good resellable state if you have to resell the house. And if interest rates fall, consider refinancing. This can greatly reduce your mortgage costs moving forward. So although you will have to incur more closing costs if you refinance, so you have to make sure the numbers make it worthwhile. And generally, if interest rates fall at least 2%, it might be very well worthwhile. So here's a worksheet. There's a basic worksheet for refinancing that you can complete to get a better idea of refinancing right now is worth it. So in summary, if you're going to make these two big purchases, the automobile and the home, make sure you do your homework. You understand what you want, what you need, what you can negotiate, how much it's going to cost. Um, Decide whether you're going to buy or lease that vehicle. Choose a, same thing with a house. Choose a house that meets your needs, shop around, know the neighborhood, get the most out of your mortgage. These are all things that are really important. And, make putting the work in up front before you make these purchases can save you thousands of dollars over a lifetime and keep you from being ripped off, feeling unsatisfied, buying something that you're not happy with. So putting the work up front is definitely always a good thing. Okay, thank you for your time, and I'll talk to you soon.